Welcome back to the channel. My name is Miles Deutscher, and this is the first installment of a new series called the Weekly Roundup, where every single Friday we are going to go through the biggest events of the week, dissect them, and talk about the potential implications. Today, I want to give a market update in the context of what has been a pretty big week for the macro side of things with CPI data, and then obviously the FOMC rate hike decision, USDT FUD, which caused a lot of panic on Twitter, as well as the big story of the day, which is the BlackRock ETF, which may be giving us a sign as to what is happening in terms of TradFi's takeover of crypto, given the recent SEC crackdown. So there is a lot to discuss today. It's going to be a massive market update, as it was a huge week. And to make sure you don't miss a single video on this channel and you don't miss these weekly roundups, make sure to click the subscribe button and turn on post notifications so you will be notified every time I upload. As I said, I'll be uploading these once a week. So where do we start in terms of the market? Let's start with the macro price structure for Bitcoin. Now, basically, we are currently testing what is the previous range high for Bitcoin. We've recently tucked below the 200 MA on the weekly. This is a bearish sign and maybe alludes to more potential downside in the short term, but we do know we do have support around the 23.8 to 24.5 level. We did reject off 31K. Bitcoin didn't just have enough steam during that banking collapse to continue to push higher, and we ended up rejecting off that level and are now testing a key level, which is the previous range higher. If we go into the daily, the trend for Bitcoin becomes very clear. We've basically been in this downwards descending pattern here. As you can see, we put in our highs at 31, then you have your lower highs starting to set in, deviation above this trend, but largely tucking back in below to create more lower highs in confluence with lower lows as well. So you're getting lower highs and lower lows, basically confirming a downtrend, downwards channel for the Bitcoin price. Now, the next major level, if we look at, let's say, a head and shoulders pattern, we can assert that the price target for Bitcoin from this pattern would be 24K. It seems to be like that's what happened. We did have the break of the neckline on this head and shoulders, and then we have come down. Bitcoin found support at 26.5, which is a key level for Bitcoin, but then it actually broke below. You have your SR flip to the downside, and then you have your targets of 24K. So all signs are pointing to downwards momentum, and I don't think it was a great week for Bitcoin or altcoins in terms of price performance, considering the S&P's been ripping. So you actually see the Nasdaq being fueled by a few select very strong tech performers, specifically in the AI niche, which has resulted in very strong gains in the stock market. And now the S&P index has started to catch up and actually has broken above a very key 4,200 level. Now, this is a level that we've been watching a long time on our charts for the stock market, and it absolutely smashed through, but crypto actually lagging significantly behind equities, which is not the best sign. And I think there are a couple reasons why crypto is lagging behind equities. The first and foremost reason is obviously the SEC's crypto crackdown has created an ambiguous regulatory environment for crypto. And I think you couple that with iffy macroeconomic data and the fact that crypto doesn't have these tech stocks that are carrying the index, and that has led to underperformance of crypto. The other thing to note is that during the banking collapse, crypto actually massively overperformed, specifically Bitcoin. So when Bitcoin overperforms for an extended period, what we sometimes see is recalibration or recorrelation to the baseline index, in this case, the S&P or the Nasdaq. So a few factors have resulted in crypto losing relative strength versus the stock market, which isn't a good sign, because if crypto's not pumping when the stock market's pumping, then what happens if we do get a correction? If this rally is overbought, well, I think you can assert that there's further downside for the crypto market, but we just need to keep our eye on it. So let's go through the macro data that we got this week and what it actually may mean for risk assets like cryptocurrency. It was a big week. We had the US CPI data, the Hinman docs becoming public, which gave a boost to the XRP case. We had the SEC and Binance both have court hearings to some extent. On Wednesday, we had PPI data and the FOMC meeting, and then on Thursday, we had key data as well. So let's break down all of that data. The first thing was obviously the CPI, which actually came in lower. So overall US CPI moved down to 4% in May, which marks the 11th consecutive decline in the year-on-year rate of inflation, and subsequently the lowest level since March 2021. The US core CPI, which excludes food and energy, moved down to 5.3%, which isn't as strong as the the overall CPI index, so that is still lagging slightly, but it was still the lowest reading since November 2021. And as you can see here, inflation in the US is continuing to trend downwards, which was a good thing. So CPI kicked off the week on a decent note. Crypto didn't actually respond that positively, but it did hold up, despite a lot of the SEC carnage that hit the market on the weekend. But it was the reaction to the FOMC which caught a lot of crypto traders by surprise, and that caused mass liquidations on the market. And basically what happened was altcoins led the sell-off with the SEC news towards the end of last week. Bitcoin and Ethereum were relatively resilient, but post FOMC, we started to see the negative performance shift over into those major caps and Bitcoin and ETH as well, and that subsequently resulted in a sell-off in Bitcoin and ETH. So the summary for FOMC is basically the Fed decided to leave the interest rate unchanged, which was the expected probability heading in. I think the market was pricing in a 80 to 90% chance pre-FOMC that the Fed would give us a pause, which they did. 2, there was a unanimous decision for rate action. 3, they're holding rates steady to assess policy impact. So it's not a full-blown pivot, but it is a sign that the Fed is starting to pivot this, higher for longer stance. But it did allude to potential rate hikes throughout the remainder of this year. And we can see that they did highlight the possibility that we do get 2 rate hikes for the remainder of the year. As you can see, Fed holds off on rate hike, but says 2 more are coming later in the year. I think what surprised investors, and one of the reasons why crypto responded negatively post FOMC, was the dot plot, where individual members of the FOMC Council indicate their expectations for rates. The dot plot was slightly shifted, which alludes to a slightly more aggressive or more hawkish Fed than some people expected. We can see this here with the market expectations for the Fed funds rate, indicating that we get 1 more hike this year, slightly lower than what they alluded to in Jerome Powell's presser, but still means we still have more hikes to come, despite things starting to slow down. It is, of course, one of the first months in many months consecutively that the Fed has not decided to hike rates. So that is something major to take note of. So what is the reason why crypto sold off despite equities reacting quite well post FOMC? Well, I think there was a lull in the market. I think a lot of traders that were planning on selling or planning on de-risking rather decided to actually wait for FOMC to see if there were any major surprises or shocks before actually executing sells. And of course, we did see a little bit of a liquidation cascade, which contributed to the severity of the decline earlier in the week. And when I talk about a severe decline, if we go onto the Bitcoin chart, obviously historically for Bitcoin, this isn't a huge dump, but it was, something noticeable with, you can see the rejection of this trend here resulting in a 5% move to the downside before things have actually slightly corrected today and have swung off their lows during the USDT FUD, which impacted the market. That's something else we are going to discuss. Let's move on to a big topic. It's in the title and the thumbnail of today's video, and that is, of course, BlackRock deciding to file for a Bitcoin ETF. So if things are looking grim in the market, this is actually positive news in my opinion, but it does allude to an agenda here that is being perpetuated by the SEC and by big corporations, in my opinion, to take over the crypto industry. And I'm going to explain that logic. So basically today what we saw is BlackRock, who manage $10 trillion AUM, officially filed for a spot Bitcoin ETF. This image here is taken from the Security and Exchange Commission's website, which shows the official registration of an iShares Bitcoin trust. Funnily enough, one of the major custodians named in the trust was Coinbase, which is an unregistered securities exchange in the US. Interesting that they decided to pick them. Does that allude to a Coinbase settlement? I'm not sure. BlackRock's not stupid. They wouldn't have named them if they didn't think they were the right fit. But the bottom line here is that I think the chances of a Bitcoin spot ETF have now significantly increased. I know for years we've been talking about a spot ETF, there's been filings, we haven't been gifted it. I think the reason we haven't been gifted it is because we haven't had the appropriate association in the eyes of the SEC taking control. And BlackRock, who are one of the biggest traditional financial players in the US and obviously in the world, the SEC might feel more comfortable giving them a license. And I think that's one of the reasons why the probability for a license here is higher than, let's say, a Coinbase or, a Valkyrie, etc., or a Grayscale spot ETF. This could be the first Bitcoin spot ETF. What does this mean for Bitcoin? Well, it does open the door to retail and institutional investors to be able to access Bitcoin investing more easily via the stock market. It would be a huge step forward for Bitcoin because futures ETFs and spot ETFs are very different. Spot ETFs, in my opinion, being being far superior, and the effect on the net price of Bitcoin over time, I think with a spot ETF would also be far superior, as investors are more likely to invest in a spot Bitcoin ETF. Now, Thicky Thought, who is an analyst that I really respect on Twitter, said, obviously, if approved, it would be a major tailwind for crypto. It's becoming clear that if the GOP wins in 24 and fires Gary, it will unlock many sources for a dynastic structural bid for crypto. Until then, we patiently wait. Just to put it in perspective, remember when CZ's 1 bill spot TWAP took us to 30K? Imagine 100 of those. Keep your powder dry. And I do think we can't underestimate the impact of a potential spot ETF. It was big news, but it was suppressed by the market because there's just so much bad news at the moment. You know, the SEC action against Binance and Coinbase, a lot of FUD, a lot of fear. You have the supply overhang of Mt. Gox, the US Silk Road selling. Like, there's a lot of reasons for people to be scared in crypto right now. And even the macro environment, despite stocks pumping, still doesn't look great. You know, you're seeing growth rates in the US dry up, although inflation's coming down, they're still hiking. What are the lagging effects of that? Is that going to send the US into a deep recession? We don't know, but there are enough question marks to substantiate why Bitcoin may not be responding to good news as much as it would in a more bullish environment, where obviously this BlackRock announcement obviously would have sent the price skyrocketing. But I think the BlackRock potential spot ETF approval alludes to a bigger, more ominous trend in crypto, and that is the fact that big TradFi could be using the recent SEC crackdown as a way for them to control crypto. Let me explain my logic here. So we have BlackRock filing for a spot Bitcoin ETF. We have Soros Fund Management saying that crypto is right for a TradFi takeover. Citadel's backed crypto exchange EDX is expected to go live later this year. And we also saw, despite the SEC choosing to sue Gemini, Coinbase, and Kraken, they gave approval to a Prometheum exchange, which is a new derivatives exchange, which actually has members of the SEC working as part of the core team. What does this allude to? Well, this is essentially what I think has happened. Big TradFi funds sat back in 2017, they sat back in 2021, and they watched crypto exhibit huge gains, 1,000+% returns over a very strong period for cryptocurrency. Whilst they were sidelined, so I'm talking the big players, BlackRock, JP Morgan, Goldman Sachs, Citadel. These guys were sidelined watching their equities grind, 10, 15% higher, but they're seeing cryptocurrency do 1,000% returns, and they're obviously feeling a bit of FOMO. But I feel like they were feeling more FOMO towards the crypto players, so the new companies like your Binances, like your Coinbase, which were profiteering billions of dollars off the now increased trading volume off the back of higher prices for crypto. So these guys are sidelined watching Coinbase and Binance rack in billions of dollars, and these guys are used to controlling financial markets. They're not used to watching some unregulated device make more money than them. And I feel like this made them feel threatened to some extent. So Operation Choke Point 2.0, which has basically been the SEC's way of controlling the on and off ramps in crypto to stifle liquidity in the ecosystem, I feel is being used as a vehicle to try and regain market control. So there's been a lot of talk about whether the SEC is killing crypto. They are killing crypto, but what they're doing is they're killing it so they can create control. So stifle the on and off ramps, limit who you give regulatory approval to operate in the US, and savor that approval for companies that you can closely work with, and they have a vested interest in that market, like these big TradFi players. So they can kill crypto via aggressive regulation, but big TradFi can step in and control US trading. This is a trend that I think is occurring. And look, in terms of whether it's bullish or bearish for crypto, you have to make your own opinion. It might actually end up being a bullish thing for the cryptos that are called commodities, like, your Bitcoins, potentially your Ethereums, many other proof of work coins, as well as select other altcoins which aren't involved with staking products. We know generally that the altcoins that are being called security have some sort of staking element to them and are proof of stake. Other tokens could be a benefit, but at the end of the day, we have to decide, whether we do want centralization in crypto. Personally, I'm not a proponent of centralization in crypto. I believe in decentralization, and that's one of the ethos behind cryptocurrency. It's the fact that it's immutable and it's censorship resistant. They are important characteristics behind cryptocurrency, and you start to remove the decentralized aspect if you have concentration of trading into a few entities. Now, is that different from Binance owning 70% market share versus BlackRock? I'm not necessarily sure. Maybe it's not. Maybe it's, the kind of a choice of two evils from a centralized perspective, but it is a very interesting landscape shift at the moment, and it's one to pay attention to. Now let's go to what I think was some of the biggest news of the week, at least on Twitter, the USDT depeg. So I'm going to quickly explain what happened here and why potentially the rumors here just may not be done for the time being, and why Tether rumors just aren't going away, and why there could be potential issues or concerns arising relating to USDT over the next few months. So just to begin with what actually happened, basically how Curve Finance works is there is a pool called the 3 pool, which comprises of 3 of the biggest stablecoins in the market, DAI, USDC, and USDT. In order to maintain an efficient swapping mechanism, the pool needs to be balanced 33% towards each of these 3 tokens at all times. If you have a balance, then that is the most healthy, efficient way for a DEX to operate. If you start to get an unbalance, so one stablecoin comprises a larger percentage of the pool than others, what you start to see is potential systemic negative effects for DeFi. So you can have very high slippage, you can have fees increasing, you can have issues with liquidity. There are many issues that can arise from the percentages skewing. Now, what actually happened over the last few days is the USDT percentage in the 3 pool absolutely skyrocketed, and it was the quickest rate of increase that we've seen in months since the FTX collapse and since the Luna collapse in the USDT ratio and curve. What does that mean? Well, it means people are depositing money or USDT into Curve in order to swap it into other stables. So when the ratio of one stablecoin goes up, it means that they're actually swapping out of that stablecoin into other stablecoins. So the significant increase in such a short amount of time made people start to worry that there were whales swapping aggressively or shorting aggressively against USDT. And we do see on-chain evidence of this occurring. Major whales, for example, CZ, Sam, Sun.eth, swapping mass amounts of USDT into USDT and taking a short position on USDT using the Aave money market. This started to get people worried that there was potentially going to be a bigger selling event affecting USDT, and as a result, there could be a potential depeg. Now, USDT did depeg for a brief period of time. At one point, it even hit 97 cents on some illiquid exchanges, but that was quickly recovered as there was a huge arbitrage incentive to buy back USDT and get it back to peg, because for all we know, Tether does have one-to-one backings of its reserves. So the founder and CTO of Tether, Paolo, came out and said, markets are edgy these days, so it's easy for attackers to capitalize on this general sentiment, but at Tether, we're always ready, let them come, we're ready to redeem every amount. And if we look through their audits, which is via their consolidated reserves report, we can see that they have a $3 billion premium of assets versus liabilities, meaning US dollars that they actually hold in the form, of treasury bills, bonds, liquid cash, etc., versus the amount of USDT that has been minted. Because we know how the mechanism works. If you have a USDT, theoretically you can exchange that to Tether for one real US dollar. Now there is a slight lag because some of the maturity dates on their bonds might take, a month or two to mature, but at the end of the day, it still is underpinned. And that's what's made Tether so profitable over time. The fact that they can earn, 5% on your USDT, basically just for them holding it like a bank would hold your US dollars. So they're basically like a big crypto bank. It's a very profitable business model. But concerns over time have arisen over whether Tether's audits are actually transparent. There's been demands for more rigorous audits to be conducted on Tether and USDT, and one of the parties that has, really wanted transparency in this regard has been CoinDesk, the media outlet. After the settlement in 2021, and this was an official article that Tether posted, which, exposed some of this, CoinDesk sought, under New York's Freedom of Information law, public disclosure of materials relating to the first of Tether's quarterly reports. This morning, which was yesterday at the time this article was posted, the New York Attorney General's office provided responsive documents to CoinDesk. They provided these documents because Tether decided to drop its opposition to CoinDesk. Now, this is where things get really juicy. We find it suspicious that today's attack on USDT via both DeFi and centralized exchanges occurred on the same day that materials were handed over to CoinDesk. This timing raises questions. All the same, Tether has nothing to hide and we hold the utmost confidence in the accuracy of our figures, while the sensitivity that we had to a government agency releasing confidential data, at least as it pertains to Tether's reserves, is lower now than it was in 2021. We remain vigilant about customer data. We cannot count on fair coverage from CoinDesk. This was the most interesting line of the whole thing. We cannot count on fair coverage from CoinDesk, which may allude to the fact that there is a Coinbase article with their findings from the new documents that they have received is going to come out in the near future. So could there potentially be more Tether FUD on the way? I think so if CoinDesk publishes this article, because Tether is already alluding to the fact that CoinDesk may not give them a fair representation. Now, whether this is Tether just trying to protect themselves against what they know is some pretty damning reports, or whether they just genuinely believe CoinDesk has been acting in bad faith, we will need to see. But nonetheless, it may not be over for the Tether saga. So Adam Cochran also said the market action, which was, the short-term USDT depeg, maybe because Tether financials have been leaked to CoinDesk. Tether front ran it with a blog post saying we can't trust the results. This should get interesting. So, look, there is a lot of stablecoin FUD, but at the end of the day, if you're diversified across a variety of stablecoins, I think you're okay. I mean, I obviously don't want to hold all USDT, but I'm diversified and I still think USDT is 99% fine. Then maybe that 1% is not fine, and that gives me enough of a reason to diversify, but I'm not panicking about USDT. And funnily enough, as you can see on the screen in front of you, stablecoin FUD often marks local bottoms. And so far, the stablecoin FUD yesterday has marked a local bottom. Now, it's only been a day, so we'll need to see if this plays out over a few weeks. And I'm certainly not trading solely off the back of this thesis purely, but I do think it's important to note that, when we had the FUD about Tether in June 2022, that we saw a very positive price response. When we had the Tether FUD in November 2022 around FTX, we had a huge rally off the lows. And even USDC, when that depegged, that caused a lot of FUD. We also had a rally off the lows, a pretty strong one from 22.5 all the way up to 31K. So the market typically does respond positively to these events. Another bit of positive news for crypto, this was very, very interesting, was news from Hong Kong that their two of their biggest banks, HSBC and Standard Chartered, have been pressed by Hong Kong regulators to take on crypto clients. So what we're seeing right now is a big shift away from the US, with innovation being effectively driven out of the US offshore into other nations, China using potentially Hong Kong as a proxy here for opening the gates to crypto without explicitly having to do it themselves. Now, Hong Kong, technically it's not mainland China, but it is a special administrative region of China, which means that if mainland Chinese investors want to access crypto, potentially they can now do it through Hong Kong, which opened up the gates to retail trading on June 1st as a way to get exposure to crypto. And I think by and large, this really spells the shift that we are currently seeing from China and from Asia, from being, anti-crypto at times, and China, flat out anti-crypto with its crypto bans, to being pro-crypto, or at least seeking opportunity in the face of what has been an aggressive SEC US crackdown. So Nick Carter said, Hong Kong policy is literally the direct opposite of the US. So instead of shutting down the crypto banks and cutting the on and off ramps, they're actually trying to get more banks to support crypto. Like, the regulators are actively pressing them to do so. The complete opposite of the US. And Nick says, whether or not you think it's the US or Hong Kong that's being prudent, it's starkly clear Hong Kong sees failed American policy as a huge opportunity for them. And it's not just Hong Kong, it's also Europe, who are introducing a new MiCA framework. The UK, who the new Prime Minister has been very pro-crypto and wants to make the UK a digital assets crypto hub of the world. The UAE, who's been very open to crypto as well. They have a multi-billion-dollar crypto startups initiative fund. We know Dubai is also starting to become home to a lot of crypto companies that are leaving the US, and that's alongside, A16Z opening a new London office, Coinbase and Gemini launching international platforms, Russia's Sberbank now offering crypto trading. There are nations here that are going to take advantage of the mistakes, in my opinion, that the US are making. So it's not over for crypto. I mean, this is what crypto is built for. At the end of the day, we want the US. We really do want the US in crypto. They are one of the biggest retail traders in the world, and they have the biggest institutions financially in the world. We do want them. But if they aren't going to join us, then crypto won't die. Crypto is immutable, crypto is censorship resistant, and it really is built for this. And these countries aren't stupid. if they see the US cracking down, they're going to see opportunities to take advantage of the decisions that the US is making. So that is why, even in the face of SEC action, I'm still long-term bullish on crypto. Now, does this affect altcoins? Yes. A lot of alts, may be generally structurally negatively affected by this for a long time, especially the tokens that have been named securities. We can already see here on the graph in front of you that the securities index, so the 19 tokens that were deemed securities by the SEC in the Binance and Coinbase lawsuits, have been significantly underperforming the commodities index, which is comprised of Bitcoin and ETH. The Commodities Trading Futures Commission says that Ethereum is a commodity. We have the SEC, Gensler, admitting Bitcoin's a commodity. Whether he agrees on Ethereum is another discussion, but for the sake of this argument, in the short term, crypto securities have been performing much worse, and in the long term, this trend may not go away given how dominant the US is in terms of the overall crypto market. And look, altcoins in general, the reason for their underperformance is also down to the fact there is supply overhang at the moment from Voyager, who have been forced to liquidate consistently over the last few months, and now Celsius today saying that they're going to be selling all altcoins from their customers. That combined with the fact Robinhood is liquidating hundreds of millions of dollars worth of people's tokens in Matic, Sol, and ADA that they hold on the platform. This is causing a supply overhang for a lot of alts, and it's one of the reasons why alts have been underperforming Bitcoin and ETH as well. If we look through the Celsius announcement and we look through their holdings, we can see that they hold a significant amount of Matic and ADA. They also hold a little bit of Solana. Unfortunately for these three tokens, it's been a rough couple of months, and especially a rough week, considering, you have Robinhood saying people can't trade it, other exchanges starting to, delist them, and then now you have Celsius coming out and saying that they're going to be selling some of their holdings as well, the three of which are included. But I think Matic is by far the biggest holding. I wouldn't worry about the Celsius token. Link as well, Litecoin. Look, not huge amounts as we go down this list, 1, 2, 5 million. It's not going to hurt the market at all. And even like 50, 26 million of selling, it's not going to kill prices, but it does cause a little bit of panic. And it's one of the reasons why if we look at the performers over the past day or so, that you do have coins like a Matic performing worse on a relative basis, because the market knows that there is a little bit of selling to come here. And, all this, FUD for altcoins with the SEC news and the supply overhang, etc., it just has meant that alts have been performing weaker versus Bitcoin. It's undeniable at this point. I mean, Bitcoin smashed through its range high on the Bitcoin dominance chart, which is a range it's been in since 2021. This was a pretty decisive breakout. We kind of got faked out here. We had the rejection off this level, but then you made your higher low. That acted as fuel to give dominance enough strength to push above. Now you might see something like this where we get a bullish retest from a dominance perspective, and then, we do push higher and make a higher high. That is definitely something that can happen with a target of 53% on Bitcoin. Does the BlackRock potential Spot ETF approval bode well for Bitcoin versus alts? Probably. Maybe gives investors more confidence in Bitcoin. Dominance can go a lot higher now. So that's just something to keep aware of. Now, in terms of whether I'm buying alts or not, look, I'm buying Bitcoin and ETH every month. I DCA. Most of my portfolio is skewed towards Bitcoin and ETH. Altcoins are a great proxy to make more Bitcoin, to make more ETH, but DCAing and trying to catch a falling knife on a bunch of alts is just not my strategy for this market. I view it as too risky. Will I take altcoin narrative trades when I see opportunities? Yes. Will I stack altcoins that I believe are fundamentally undervalued? Yes. But will I do so with weightings that significantly supersede my Bitcoin and ETH weightings? No. Bitcoin and ETH always going to make up 50% plus of my portfolio, if not more, because I believe that Ethereum, even in a bull run, can still lead that initial section and give me ample time to trade back into hot narratives. The other thing to note is that the altcoins that perform next cycle won't be the ones that performed last cycle. So with altcoins, obviously, you have security risk, you have just the risk of more volatility, but then you also have this added risk of you don't know what the tokens next cycle are going to be in terms of the outperformers, because in 2017 you had these coins like Neo perform that underperformed in 2021, and in 2021 you had tokens like AVAX and Luna and Sol and Phantom that performed. Will those be the best performers again in the next cycle? I mean, history suggests probably not. There's probably a bunch of new shiny objects that the market prefers next cycle. So for that reason, I prefer not to bag hold a shit ton of alts. Of course, there are some alts that I love holding and I love trading, and there's tons of narrative trading opportunities opportunities. But for me to go much, heavier on alts, I'm going to need to see a significant reversal on the ETH BTC chart, because this has been a downtrend on ETH BTC. And as we know, ETH typically leads the alts. So being in a downtrend, I would need to see some sort of reversal, a break of this diagonal for starters, and a reclamation of the 0.7 level to start, targeting the 8.4 region again. Until then, I think your next best bet is maybe shifting it into some alts at the 5.7 to 6 level down here if this pattern keeps playing out, and we could see us hit that level in September, October. That might be a timeline for buying altcoins during this period, or at least going more aggressive. Until then, Bitcoin and ETH, I'll be stacking slightly more aggressively unless one of two things happen. One, we have an SR flip of this resistance level into support, then we can have upper targets on ETH BTC, or, we come and we test the lows here, and then you're kind of buying support. And it's a better level than buying, no man's mid-range of the current ETH Bitcoin range. Why am I looking at ETH BTC for alt strength? Well, because Ethereum typically leads the altcoins. And if Ethereum leads the altcoins, I won't buy alts unless Ethereum looks strong versus BTC, at least not aggressively. Now, there are some things I'm interested in, like GLP, a lot of the perp dexes, the LSD plays. They're kind of exceptions for me right now, given their relative strength. But in terms of just stacking and blindly holding alts, that is my plan. So in terms of what is coming for the week ahead, it's a slightly less busy week from a macro perspective, but I still think we're going to get a lot of news. SEC news, maybe news on, more TradFi funds or businesses entering the crypto market. In front of you, there is a lot of altcoin stuff that's being announced. So I think this SEC stuff is going to continue to be the driving narrative behind the market, and probably, the number one thing to watch. We just need to stay vigilant, adaptive, and now is really the time to pay attention. Now is not the time. I know it's kind of counterintuitive, right? Because you might think, market's boring, the prices are down, I'm not going to pay attention. Now is actually the time to pay attention, because things are evolving so quick. And if you could be quick to the next narratives, this is the best time to set up your portfolio for next cycle. Not when prices start pumping and then, you're FOMOing in. Now's the time to research. Now's the time to pay attention on where the regulatory environment is heading, because that is going to create opportunities. Of course, I'll keep you updated every single week in this format. I hope you guys enjoyed this kind of weekly update style format. If you did, click the like button. Of course, also subscribe and hit the notification bell so you don't miss a stream every single Friday. And of course, I'll keep you up to date if anything happens on Twitter. So I hope you like this video. And yeah, in front of you, you can screenshot if you'd like to get some of the altcoin news from Abe's prologue over the next week. And until the next video, I will see you later. Peace out.